A recent Bloomberg article is suggesting that Glencore should give ground to secure a merger with Rio Tinto reeks of short-sighted financial opportunism disguised as strategic foresight. Let's be clear, this proposed merger is not about efficiency or growth. It's about further consolidating power in an industry that is already plagued by monopolistic control, environmental devastation, and regulatory loopholes. The argument that a Glencore-Rio Tinto merger would create a stronger mining giant is a tired trope used to justify every mega merger that has ever gone wrong. We have seen this play out before. Monopolistic dominance leads to fewer choices for suppliers, weakened bargaining power for workers, and ultimately skyrocketing prices for consumers. Consolidation in industries like tech, banking, and energy has only proven that when fewer players dominate a market, innovation suffers, costs rise, and ethical concerns are swept under the rug. Glencore's history of controversial trading practices, corruption scandals, and environmental violations should be enough reason to question whether it deserves an even greater foothold in the global commodities market. Meanwhile, Rio Tinto, with its long-standing reputation for destructive mining operations, including the infamous Yukon Gorge disaster in Australia, is hardly the ethical partner that should be rewarded with more market control. Together, they would create an entity that is simply too big to regulate effectively. The Bloomberg article conveniently sidesteps the harsh reality that such a merger would crush competition in the mining and commodities trading sectors. Both Glencore and Rio Tinto hold significant stakes in global iron ore, copper, and aluminum production. A combined entity would have the ability to dictate prices and terms in a way that could be catastrophic for smaller mining operations and resource-dependent economies. This is not about efficiencies, it's about market manipulation. When a handful of companies control the bulk of the world's raw materials, resource nationalism increases, trade tensions escalate, and economic vulnerabilities deepen. The last thing global markets need right now is another behemoth dictating the flow of essential minerals. Proponents of the merger might argue that regulatory bodies will step in to prevent abuses, but history tells us otherwise. The mining industry has long been a master at sidestepping regulations, exploiting tax havens, and negotiating sweetheart deals with governments desperate for investment. Expecting regulators to control a Glencore-Rio Tinto giant is akin to putting a Band-Aid on a bullet wound. It's ineffective at best and negligent at worst. Moreover, the environmental and social impact of such a merger cannot be ignored. With both companies having a track record of environmental degradation, how can we possibly expect a merged entity to prioritize sustainability over profit? The bigger the company, the harder it is to hold accountable. Rather than cheerleading this disastrous proposal, financial analysts and journalists should be calling for more competition, not less. The world needs a diversified and responsibly regulated mining sector, not an industry that bends to the whims of a few corporate giants. Glencore and Rio Tinto should be scrutinized, not empowered. If anything, governments should be moving toward breaking up existing corporate dominance in the mining sector rather than facilitating even greater consolidation. The suggestion that Glencore should simply give ground to secure this deal is naive, dangerous, and an insult to those who will bear the economic and environmental costs of such reckless consolidation. The only thing more disastrous than this merger would be the blind acceptance of it as inevitable. It is not, and it should be stopped. Joseph Schaffhausen, my independent commentary for Skillings Mining Review.